glad you could make our time to join us on today's episode of Tax Matters. My name is Olumuyiwa Matuloko. How's your week been and how is business going? With me on today's episode is Radiant Christina.
Hello viewers.
On the last episode of the program, we told you the story of the National Revenue Retreat, which was held in Kano from the 14th to the 15th of July 2016. One of the major papers presented at the Revenue Retreat was that of Mr. Babatunde Fowler, Executive Chairman, Federal Inland Revenue Service, who spoke on focusing on non-oil revenue, the way forward. Time only permitted us to bring you the first part of that presentation.
Before we had to move on for the next program, Mr. Fowler was looking at the use of technology in tax deduction, one major component of which is automated VAT deduction and remittance.
Yes, he spoke about the failure or refusal, if you like, of airlines, multinationals, telecoms operators, and oil and gas companies to deduct VAT at source, and sometimes when they deduct, failure to remit. Mr. Fowler continues on that trajectory today, especially with regard to the same problem of non-compliance by ministries, departments and agencies at both federal and state levels, and of course at local government level.
We have some state governors who have not remitted VAT, have not remitted withholding tax, and in talking to them, they said they'll turn a new leaf. And let me just give you a little scenario as to how it looks. In every state budget, just like Lagos State that said they want to do 60-40, if you've got capital of 6% of your state budget, assuming you have a budget of 100 billion, 60 billion for capital and 40 billion for recurrent or whatever, or non-vatable items. It will mean that out of that budget of 60%, there will be withholding tax, especially if you deal with the limited liability organization. There'll also be a VAT element. So if you, in your mind, you look at all the budgets of the 36 states and the FCT, clearly, between all of them, they intend to spend well over 2 trillion. Now, out of that amount, there are taxes that should go to the FIRS, to the Federation account. And what we're now doing is that we wrote to all the governors recently and offered them free software, free technology, which will be put in the office of the Accountant Generals, which will deduct at source the withholding tax and the VAT due to the federal government. And as a bonus, we also had the software that will enable them deduct pay tax also for their own states. Verbally, they have consented. We have received letters from 2 states or 3 states saying we should come and implement it. At the local government level, the situation is no different. They have not been remitting their taxes, and we will propose sometime this month through the Honorable Minister of Finance, and of course with the help of my brother, the Accountant General, and there is a law which permits us to deduct at source all outstanding VAT and withholding tax to the Federation account. Now, between the federal government and the state government, I can tell you that that is close to 30% of the budget. Now, we're not unmindful that they're going through some hard times, but the truth of the matter is that if all the money that has been passed for the current budget is made available to them, the whole country will be better for it. Taxation has to be fair. Some people cannot be contributing and others not contribute and share from the common pot. It has to be something that everybody will chip into. We also have the support of the Minister of Finance, and in any payment to be received through the Ministry of Finance, through the Office of the Accountant General and the Debt Management Office, we're working together. I'll give you a typical example. Those who are being paid all subsidy, companies that were being paid for oil subsidy, They sent the list to us, and we verified those who were tax compliant and those that were not. And they have had various stages of payment. On the last payment that we just processed, and I'd like to say that we have received the approval from the DMO, out of the payments of, I believe, about 24 billion or thereabouts, at least we were given 3.1 billion for those who are not tax compliant, and that money was deducted at source. And this is an ongoing process. So the issue of taxation, one is one of education, the other of convenience, and one of enforcement.
The executive chairman also touched on self-assessment returns filing.
We have decided to partner also with consultants who will help us verify the self-assessment, because to date, in trying to encourage self-assessment, we found out that a lot of organizations, including multinationals, were not truthful with the self-assessment figures, which to my mind is criminal, because when you falsify records to government is actually a criminal act. And we've also published in the papers that we will be inviting the chairman of the boards, apart from the CEOs of those companies, to explain certain issues. We met with all the major audit firms in Nigeria, and we asked them to partner with us. Now, we have this MOU. I'm not sure everyone has it, but we have a few copies here, between us and the state boards of internal revenue. And the whole essence was, instead of having, if you have offices in 36 states, for example, maybe you're a bank or you're a big company, instead of every state board of internal revenue coming to check your books for state tax, let's have a joint audit. We'll do one audit that will take less than 2 to 3 weeks, and then it covers you for the whole year. I can tell you to date, some of the audit firms and accounting firms said it's a very good idea, but no one company has signed up for that joint audit. Now the question is, why have they not signed up for that joint audit? Simply because some of them have got a different set of records for FIRS, a separate record of records for the state, and a separate set of records for the bank. Now, with this agreement, whether they want a joint audit or not, we will still compare notes. So, in making sure that all T's are crossed and all I's are dotted, with this agreement between the state boards and the FIRS, at the end of the day, we'll still get the information that we want.
And of course, the Federal Inland Revenue Service is also realigning its offices for greater taxpayer convenience.
We had, in the past, desiccated offices for taxpayers, and we still have them. We have the large taxpayer office, the medium, and all that. But because of the spread of these offices, we found out that in some states, depending on where your office is located, for you to visit the tax station, you may have to drive to another state. And that is the truth. You may have to drive for an hour or 2 hours to see your account officer. Now we're making it public and known that the taxpayer will choose the location of where he wants his tax file to reside, meaning that no taxpayer will have to travel for more than 30 minutes to see his account officer.
Still on the use of technology for enhancing revenue generation.
We also had a situation of stamp duty. We had representation in 14 states, meaning that we had stamp duty machines for agreements and other documents in 14 states. And that would certainly mean that if we don't have representation in your state, you have to travel out to your state to get your document signed. So we've given out a contract to import 100 new modern stamp duty machines so that will be in every major state capital and major area of commerce across the nation. Now we've also taken it a step further in working with CAC. When most of you want to register your company, you have to get a lawyer who will tell you, I'm going to Abuja. I'm going to spend one night in a hotel, and he'll come back with a bill, or he'll tell you that he has to wait to get 10 briefs. So he'll take 10 company names and share the cost among you. In the next month or so, we already have someone working on having a with technology-based solution, whereby if you even go to CAC, at the point of registration of your organization, of the new company, you get a tax ID card. If there are any payments to be made, you can also pay from any point. You can pay by your phone, you can pay from your office, and you'll just, I don't know how many of you have applied for a US visa before, but when you send in your application at some point in time, they send you a form with a barcode. You get a barcode which will be stamped on your documents, and that will be your stamp duty payment without you leaving the comfort of your home.
The Federal Inland Revenue Service FIRS calls on all corporate organizations operating in Nigeria to register for the purpose of payment of taxes and obtain a tax identification number TIN. All registered companies must obtain a tax identification number immediately from the nearest FIRS office. You can also collect and return tax registration forms from the Federal Inland Revenue Service Engagement and Enlightenment Tax Teams, FEAT, on compliance checks exercise in your area. A company which is yet to commence business after at least 6 months of incorporation must pay a pre-operational levy of 20,000 naira in the first year and 25,000 naira for subsequent years to obtain its tax clearance certificate TCC. Note that filing and payment of VAT and withholding tax returns must be done on or before the 21st day of every month. Register for VAT. File all tax returns as and at when due. Be a responsible corporate citizen of Nigeria. It pays to pay your tax. This message is from the Federal Inland Revenue Service.
Welcome back. It is indeed a new dawn in tax administration in Nigeria. In the first part of this feature on the 2-day National Revenue Retreat, we brought 2 snippets from one of the other major papers, that of Malam Shetima Umar Abagana, acting chairman of the Revenue Mobilization, Allocation and Fiscal Commission, RMAFC. Mr. Abagana's suggestion with regard to the increase in the rate of VAT in Nigeria has generated heated debate in the polity. We want to share with you fuller details from that paper.
Over the years, Nigeria's revenue yield from taxes has remained low despite its huge potential. The reasons that have been adduced for this trend include low taxpayers' education and understanding of the importance of taxes, poor legal and enforcement framework, institutional inefficiencies of tax authorities, leakages in the tax system leading to fraud, diversion, outright embezzlement, etc., taxpayer apathy caused by corruption and poor service delivery by successive governments, leading to low morale of taxpayers and poor voluntary compliance. Large informal sector outside the tax net, low taxes of the affluent for income redistribution, and abuse of tax holidays, waivers, exemptions, grants, etc. Having noted some of the constraints responsible for the low tax yields, as highlighted above, what options, remedies, then do we have to expand the tax base for greater revenue yield? 1, expanding the nation's tax base is very important. Nigeria has a very large informal sector and informal businesses that are not well captured in the tax net. To expand the net, there is the need to develop a very comprehensive database of all commercial activities in the country that will provide critical information on the location, category, and income of taxpayers and businesses. Success in taxation is significantly related to its database. 2, the higher the level of education and consistency in enlightenment to our taxpayers about the importance of taxation for national development, the more the likelihood of voluntary compliance to pay taxes. Therefore, investment in tax education to be given a priority. 3, provision of supportive legal framework and institutional logistics for enforcement, e.g., revenue courts for trying defaulters, etc. 4, restricted application of import restriction waivers and concessions. It is estimated that between 2011 to 2014, Nigeria lost 1.3 trillion naira through waivers on rice and other commodities. Current tax rates, charges, and fines should be reviewed upward. One of such rates is the VAT rate. In fact, Nigeria's VAT rate is known to be among the lowest in the world. An upward review from the current 5% to between 7.5% and 10% is therefore recommended. VAT is so important that a comprehensive research should be initiated to go around the country and collect data from the Corporate Affairs Commission, banks, states' ministries of trade, etc., to really determine and capture all possible VAT targets. That's all businesses in every local government and every state. Table 3 shows that VAT revenue in Nigeria in 2014 was 802 billion naira. In South Africa was equivalent of 3.13 trillion naira, almost 4 times what Nigeria has earned. Now, I am not averse to recommending increase in taxes or even soliciting for new taxes. People don't want to pay tax when they know that their funds will not be managed properly. Either the funds will be stolen, corruption eats into it, or they won't get a proper service delivery. But with the kind of government we have now, with the leader we have now that is disciplined and honest, Nigerians should be able to be free to pay more tax, and I'm not afraid to mention that there is need to pay more tax because the funds will be managed with great honesty. Distinguished participants, in addition to increasing the net tax rates, etc., as mentioned above, that's the tax net, the net of collecting all the taxable people, and then the tax rates itself, as mentioned above, there's need to introduce completely new taxes or reintroduce cancelled ones to further boost the revenue base. Some of these include A, road toll tax. These are the taxes collected at toll gates. Luxury goods. A luxury tax is a tax on luxury goods such as mansions, exotic cars, private jets, jewelry, which are indeed non-essential products. For instance, Nigeria is said to have more than 200 private jets, and this is more than the commercial jets right now flying around the country. How much tax do they pay? The luxury tax will essentially target the wealthy in the society because they are the most likely to pay for luxury goods. The tax may also be applied only to purchases over a certain amount. For instance, some US states charge luxury tax on real estate transactions over a certain limit. Since Nigeria's major cities, Abuja, Lagos, Port Harcourt, Kano, etc., are dotted with fantastic estates, it may also be ideal for government to impose luxury tax on them. Inheritance tax or estate tax is also a tax that can be introduced.
So Malam Abbas Ghana's paper was not only about an increase in VAT after all?
Oh, of course, no. Far from it. In fact, his paper did great justice to the mandate of his commission. He spoke about taxation in all ramifications. For example, he spoke about the need for local content. In the oil and gas sector, for example, he suggested Nigeria stopping to export raw crude, but rather locally refining and exporting petroleum and other products, from the crude that we presently export. He also spoke at length about the need for the solid mineral sector to contribute to the revenue base of the country.
Now, this local content and local processing is not only for agriculture and solid minerals, it also should be looked at in the petroleum industry. There's no reason why Nigeria today should export raw crude oil. Nigeria should have about 10 to 15 refineries, and oil companies should be given a certain amount of period to establish refineries, and they should only be allowed to export processed products and no longer crude oil. That will create employment, create business linkages, and also revenue for Nigeria. Only processed crude or agricultural produce should be exported given a certain period of time to allow for investments to take place to process them. Developing the mining and soil mineral sector. This, in the Revenue Commission's mind, is the surest way to diversify the economy and create more revenue. Before the boom of the 1970s, Nigeria was a major player in commercial scale mining, supply and export of mineral materials such as coal, tin, columbite, iron ore at the international market. At a point, Nigeria was the largest exporter of columbite. However, activities in this sector declined drastically due to neglect, unfavorable government policies, and poor management of government-owned mining enterprises. For instance, Records of National Bureau of Statistics have it that the solid mineral sector contribution to GDP reduced from 5.6% in 1960 to 0.16% in 2007. At the moment, mining of mineral accounts for only 0.3% of the GDP. Records of occurrences of solid minerals in Nigeria show that there are more than 44 world-class mineral types in commercial quantities, reserves, in 450 sites. Economists, geologists, and revenue experts agree that untold riches and wealth are buried under the Nigerian soil waiting to be exploited. It is estimated that Nigeria is losing 8 trillion naira, that's $50 billion annually, from lack of mining gold alone. Table 5 gives some estimated reserves and value of some of the minerals in Nigeria, some going up to copper, $700 million worth, gypsum, $250 million worth, lead zinc, $400 million. Distinguished participants, it would be interesting to know that these huge reserves, the solid mineral sector never contributed anything to the Federation account all these years. It was only recently, about 2-3 years ago, that the Revenue Mobilization and Fiscal Commission engaged the Ministry of Solid Minerals Development through its monitoring and reconciliation activities, which resulted into opening a special account at the CBN for proceeds from solid minerals. The current balance of the account is 12.6 billion naira. This is a far cry in terms of the real potential of the sector. The Commission is already undertaking the process of computing the indices for the sharing of the 13% derivation components of this fund. This 13% being given to oil-producing states also can be beneficial to states where solid minerals are being mined. So 13% can go to the crude oil producers, 13% will also go to producers of solid minerals in Nigeria.
On day 2, several papers were presented, and of course, reactions to the suggestion of Malam Abagana regarding the VAT rate.
All the years, we have been saying we have the lowest VAT maybe all over the world. What is difficult in increasing the VAT? Maybe in the gradual process, maybe 1% every year. It won't be noticed. And nobody will know that the criticism will not be much. Can't we be doing it gradually? Maybe from next year, 6% instead of 5%, year after 7%, and so on and so forth. Thank you very much, sir.
Former Executive Chairman of the Federal Inland Revenue Service, who rose to become the Accountant General of the Federation, Mr. John Kayode Nayeju, chaired a major chunk of the paper presentation sessions. On the suggestion for an increase in the rate of VAT in Nigeria, Mr. Nayeju had this to say.
In 1993, when we were conceiving the VAT, before we sent it out, it passed through a rigorous process. People came from Washington, we all discussed it. The model Nigeria adopted, it was even almost against the advice of the IMF or World Bank. But they came to praise us thereafter. Because what they advised Ghana to do, us to do, which we turned down, Ghana swallowed it. Immediately, Ghana started their own rate with a high rate of 10%. Yes, about 10%, there was riot. In the book I published thereafter on VAT, I said every two years, we must be increasing this tax rate marginally because we passed through acceptance. Last year, when they asked me, I even went to Minister of Finance that I told them, this is the time you should be increasing VAT. They asked me how much rate. I suggested between 7.5 and 10. I am the same person telling Nigerians today that this is not the right time at all. What were my reasons? There is pain in the land. If you don't know when to apply medicine, it won't work. Where we are now, for God's sake, as a consultant, as a Nigerian, it is not the right time.
And of course, the compromise at the end of it all.
But my good commissioner and professor whispered something to me that makes sense, that can make me to shift ground a little bit. They can target, which means we are going to go into a dual rate. Leave the basic tax 5% on general one. Pick some item of luxury. Define the luxury. Oh. Don't just say luxury because everybody will say it's luxury or it's not a luxury and they come over. Define it, then put the 7.5 or the 10% that should be done. That will be reasonable. That will work.
Fair enough. Let the rich bear the burden.
That's what you think. What do you think? Should we increase the rate of VAT in Nigeria? Should we have a double rate regime whereby luxury goods, so-called luxury goods, have a higher rate and then we keep the present 5% for the proletariat? Text us, tweet us, send emails, or visit our Facebook page. Let's do this again next week. Same station, same day of the week, same time of the day. From Christina.
Thank you for watching. See you next week.
Have a blessed week ahead.